Well, let's put the spotlight again on State Bank of India. And this is a CNBC-TV18 News break that stands confirmed. SBI has announced its first equity fundraise in 8 years. The bank is looking to raise 25,000 crore rupees via the QIP route. To talk about this, we have with us Rohan Mandora, Associate Director at Equirus Securities. Rohan, great to have you on. You know, we were just speaking with a guest before you, and they were pointing out how PSU banks have done such a great job of pushing on the growth curve. For SBI, what will this 25,000 crores of additional capital mean, and what are your current growth estimates that you're penciling in for this year for the bank?
Yeah, hi. Thanks for having me on the show. This growth capital would add roughly 65 bips to Tier 1 capital. If you look at what management has indicated, and at a systemic level, what we expect is the credit growth would be around 12 to 13%. Now, in the current environment, with the liquidity coming up, the rate cuts and the IT tax benefits coming in, the expectation is the second half should do well. And the way SBI has positioned with YONO, they have been doing well on the retail growth as well. And last year, as per the segmental reporting, the retail profitability had increased by almost 49% year on year. So we expect that the recent capital should be supportive on NIMs. And depending upon the environment, if things come up, it should support growth. We also consider that this could also be a prelude to a possible migration to Ind AS, wherein among the SOE banks, SBI was on the lower side. So this could also help them be more ready for Ind AS migration.
And just to recap for our viewers as well, when we talk about Ind AS, what is the additional capital requirement? Because you're saying SBI was on the lower side?
The estimate for bank-wise is difficult to estimate.
Okay.
But the way it was structured was whatever loans become NPAs, on the day one, you have to provide basis the expected loss on that portfolio. And this was to be done basis the history of last 5 to 7 years as per what RBI comes up on the historical portfolio of the bank, respective bank separately. So in that backdrop right now, where we are sitting, if it happens starting from FY27, the last 7 years have been pretty good. So incrementally, we don't expect a meaningful shift, but the norms would change and there could be some requirement for some banks that may come up. And SBI carries some surplus buffers on provisions.
So basically, it will add a nice layer of cushion when the ECL norms, expected credit loss norms, kick in and they have to be applied. Got that point. On growth, Rohan, you mentioned that you're working with 12 to 13% growth for State Bank of India. Now, let's map that with the valuation, because the other move in the market is a move towards Tier 2 banks. Better valuation comfort, better prospects of growth. I mean, look at the kind of institutional buying that happened in RBL Bank earlier this week. And now everyone's talking about Bank of Maharashtra, and these banks are, promising great growth. So where does SBI fit in the overall scheme of things in terms of, just how investors should be placing their bets on banks?
So I think the names that you mentioned, for example, RBL, it is a beneficiary in a rate cut cycle with a very high fixed rate book. So that's where I think some of these mid-sized names, AU, RBL, IDFC, are being looked at. Among the PSU pack, the way I would think is that these are all banks which would deliver 15 to 16% ROEs. Bank of Maharashtra, in that sense, is roughly 20% plus ROEs. And even if these banks don't re-rate, the book value compounding itself can give you around that kind of a return. So for me, as an advice as what we're advising to our clients, we would believe that this can be a compounding stories that one should look at, 15 to 17% basis the ROEs profile that these banks are currently operating in. The re-rating driver may come in whenever the corporate credit growth picks up. Also, the data that comes in from the sectoral bifurcation of credit, NBFC credit has been weak. So if that comes in, that thing also can support credit growth, where some of these PSU banks can play a part. So that's how I position PSUs in the investment pack.
So, okay, let me make it even simpler for our viewers. If I have 100 rupees to invest and I want to put it in banks, how should that be split? How much for a large bank like SBI, PSU Bank? How much for the Tier 2? And will you allocate anything at all to the private sector names, the large private sector names?
So I think going into the second half of current financial year, we think that large private sector banks would be doing well. They have a very high repo book, so first half is going to have a significant NIMs pressure for them. But as whatever has happened in the first quarter, most banks have been very proactive in cutting term deposit rates as well as savings rate. So we think that among that 100 rupee allocation, we would have around 50 to 60% allocation towards large private sector banks, maybe 20-25% incrementally towards the mid-sized banks, private banks, and the remaining 20-25% towards SME banks.
State-run banks. Got that.
Quick question, Rohan. Good to see you. What about credit growth for the industry on the whole? That's been faltering, right? What are you penciling in terms of a recovery? And on an average for FY26, what kind of credit growth are you expecting?
So as you rightly said, first, right now the trends are below 10%. The hope is that the second half can drive uptick in credit demand basis the cuts and the festive season picking up. Most of this would be driven by retail and MSME. We do expect that if the retail credit demand picks up and demand from NBFCs also comes in, we would expect at a sectoral level, 11 to 12% kind of a credit growth should be doable for the current year.
Okay. Rohan, just a quick word on margins as well. I mean, the SBI chairman himself mentioned when the rate cut happens that with the CRR cushioning, the second half, I think the NIM trajectory should improve. But what are you penciling in for this quarter for State Bank of India and overall margin trajectory? What's the guidance for the year or your expectation for the year?
So for SBI, for this quarter, we are expecting 9 to 10 bips kind of NIMS compression, primarily because they have one of the lowest repo link book at around 28%. And on the MCLR, they have not undertaken any rate cuts. As we saw in the results of Bank of Maharashtra, they benefited on yields from the MCLR linked repricing that happened. And SBI also has increased MCLR by 35 bips in the last 1 year and around 15 bips in the last 6 months. So we would expect some benefit to come through. So that's where for them, we are expecting 9 bips kind of a Q-on-Q compression. For the full year, SBI has also done cuts on savings rate by around, they have brought it down to 2.5%. And on the TDs, the term deposits, they have been aggressive in cutting 1 to 3 year bucket TD rates, and they have cut by around 75 to 80 bips. So in the second half, the benefits of TDs repricing lower will come in. So for a full year, we would expect that NIM should be around 2.9% kind of a range for SBI. Yeah, that's it.
Okay, all right. Rohan, thank you very much for joining us. Good speaking with you. That's a quick view as far as financials are concerned.